morning, everyone. I'm Alan Kohler, founder of Eureka Report, now part of Intelligent Investor, as well as finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And we're
the Money Café, Alan.
Yes, indeed. Now, Stephen Gold hit 4,000 US last night, which is a bit of a milestone. It's I think it's just below that now, but still it got above 4,000 for a moment, and it's up 50% this year. It's incredible. What do you make of it?
It is incredible, and we exported $6 billion worth in July alone, which is giving us a trade surplus with the US. So, well, look, it's become the new reserve place to go when you don't trust the Americans. So US bonds and US dollars are no longer the safe haven in a wild world. And so gold stocks, even outperforming big tech at some levels this year. So we are, as a nation, a massive beneficiary, and we've now got 15 of the top 150 gold miners. I mean, I've just never seen anything like it.
I was reading some research from the Gold Council this morning, and gold market trading volumes surged in September, averaged US 388 billion per day, which was a 34% increase month on month over August. So I think we're experiencing a bit of a blow-off here. I mean, this is extraordinary. Gold market trading volumes are up 34% month on month. Jesus.
Well, you did a magnificent deep dive on gold a few weeks ago in your Saturday weekend briefing for Intelligent Investor subscribers, and the number that blew me away there was that for every person in the world, there is US $2,100 worth of gold in the world. So I think in Aussie dollar terms, you're talking north of, it's getting up towards $40 trillion worth of gold in the world. So it's gone up another 20% since you wrote that 6 or 8 weeks ago. So
yeah,
it's a unique asset class. You can't use it. It just sits there as a store. There's 200,000 tons of it out there worth 30, 40 trillion Aussie, and everyone can't get enough of it because they're scared and they need a reserve, and it's a store of currency, a store of value.
Yeah. It could be time for another deep dive. What do you reckon?
I think you should. I mean, there's so many angles to it, like, the scandal of us selling 2/3 of our gold reserves at $350 an ounce in 96, to the scandal of the WA government only taking a 2.5% royalty. I mean, this gold is mainly owned by the West Australian taxpayers, and they are allowing often foreign miners to take it out of the ground and ship it off and sell it to ETFs and sell it to central banks, and the owners are taking a 2.5% clip after the first $15 million because 2,500 ounces are tax-free. So you want to talk about undertaxing in Australia, WA gold. It is a joke.
Yes, well, you mentioned ETFs, and ETFs are a big part of the demand for gold at the moment because a lot of people are buying, rather than buying physical gold, they're buying an ETF, which I think is rational because ETFs are very tradable on the stock market. And you can, buy and sell them in the same way you do shares, rather than kind of go to the trouble of getting some gold shipped to yourself and put in your garage.
Yeah, that's right. And a lot of people are also saying buy gold miners. So there's a frenzy in gold stocks. I mean, I'm getting ready for the AGM season, and all these miners in Perth, because I look at their share prices, I decide whether it's worth going. And, I'm just constantly writing market cap 250 million, shares have rocketed by 300% this year. And there are dozens of these things. There's some little outfit in Kalgoorlie, which is suddenly worth 340 million. And I'm sort of thinking of running for their board because how can shareholders get to Kalgoorlie for the 9 a.m. meeting on the last day of the season? So it is just incredible, how many, and the frenzy in Canada. There's a merger announced yesterday between a gold miner in Canada and Australia worth $2.4 billion. So we as a nation, it's just a massive windfall. The shareholders, the owners of the shares in the gold miners they're the ones that are outperforming. And if you're like the AFIC stable of LICs, listed investment companies, which don't own any gold stocks, their 4 AGMs last week were very sober affairs because they're underperforming, their shares are going nowhere, and they're sitting there going, sorry, we don't own any gold stocks. Well, if that's the case, you're underperforming.
Yes. How many boards are you running for this year, Stephen?
Look, I did 18 in the first 2 years of board tilts back 25 years ago. I did 10 in 2008, in 2001. I've only done 10 in the last 10 years. So it's been very, very lazy, unproductive time. And so now I'm doing it full time. I have decided
So you've been loafing, Stephen?
Yeah, I've been loafing. So I may end up doing more than 10. I'm writing to a lot of companies at the moment saying things like, come on, have a hybrid AGM. It's impossible for us East Coast shareholders to get over to Perth for the last day of the season. So I'm running for the board on a platform of hybrid AGMs. Unless, of course, you decide that you'll have a hybrid AGM this year. So I've got all these letters I'm expecting to come back saying, oh, we've decided to have a hybrid AGM after all, so you can go away and leave us alone. And then there's some sort of more serious ones like I'm going to have a go at a couple of billionaires who need more independent directors on the board, and probably the most interesting one is Maya. So Solly Lou's got 27%. They've only got 4 directors on the board. Executive chair, the share price has crashed. They've just taken $200 million in write-downs on the related party deal they did to buy Solly Lou's retail brands. And the 2 people they say are independent directors, lead independent director Gary Weiss, who spent 23 years on the Premier Investments board with Solly, and Rob Perry, who was the auditor of Premier Investments for 4 years during his long time at Ernst & Young. So my simple platform is the board's too small, not enough independent directors, and too many directors associated with the 26% shareholder Solly Lou, who's representing the other 73%. Vote for me if you believe in independent directors. And by the way, this is going to prove that Solly Lou controls the company, because just watch how he votes against me and controls the fact that I don't get elected. So it's just putting pressure on them to actually get some more independent directors, because they don't have any in my opinion.
So you don't think Solly will vote for you?
Well, I actually say in the notice of meeting, I've proposed that Solly won't vote for me, and this will prove that he controls the company, because he will control the fact that I won't get on the board, even if, the proxy advisors say we need some independent directors, because I'm doing the same thing with Jerry Harvey Norman. So I did that 5 years ago. I've lobbed a nomination at him. He usually goes bananas, but look, his shares are going well. So, but every year the shareholders vote 30% against the insider directors, because Jerry has not got, barely any independent directors. So you just run where there's a need for independent directors, and you create a platform for shareholders to send a protest. Yes, we want more independent directors. Everyone knows I'm not going to get elected, because my last couple of tilts it's 1 or 2% at NAB and Aristocrat. So it's a safe protest vote. And if you believe in the concept of independent directors and a company doesn't have enough, well, some dummy candidate runs to make the point, and then hopefully the outcome is the board then agrees to actually appoint real, competent independent directors to satisfy that lack of independent directors. So hopefully Maya will come out and say, we've found 3 new directors who are independents, and that might be why they've just delayed the annual meeting from November 28 to December 11. So I nominated on October 3. September, and a couple of days after I nominated, they've delayed the AGM by 2 weeks. So there's obviously a lot going on in the background. I think they might be looking for a couple of independent directors they can put up.
So tell everyone what it takes, what's involved in running for a board seat, Stephen. What do you have to do?
Oh, well, it's the easiest thing in the world. I mean, the problem in Australia is that I would rather put up resolutions. So when I was a City of Melbourne councillor, I put up 50 notices of motion in the 4 years I was on council, because a councillor can do that. But to put up a resolution in Australia, you need 100 signatures from shareholders, or you need to own 5% of the stock. So it's too hard. It's just logistically impossible. These are barriers to entry. But to run for a board, all you normally need is just to be a shareholder and nominate yourself. So it's very easy. You can do it at scale.
You just write to the company saying, I hereby nominate myself.
Yeah, I hereby nominate myself. I'm on the register. I own this many shares at this address. Please include this CV and platform in the notice of meeting. And
Right.
so you then get into a negotiation about what you're allowed to say. So the worst censorship I had was Rupert Murdoch when I ran for the News Corp board in 2002. Didn't even tell the shareholders how old I was. The notice of meeting just said Stephen Mayne. That was it. Just said nothing as to why I was running. Whereas most companies will reproduce what you say as to why you're running. But this is where we need an independent electoral commission, because it's not fair that the directors decide how the ballot paper is designed, and they'll always put, big black marks on it saying, don't vote for this guy and vote for our people. And it's all a very partisan election run by the board themselves. But in America, if you run for a board, you've got to pay for your own distribution to shareholders. At least here, it's funded by the company. So it doesn't cost you any money. It's easy to get on the ballot. But my worry is that since they've moved to online communications, 99% of shareholders don't even see the notice of meeting and don't even know you've run. So, it's not what it used to be when everything was paper. I think I ran for the Commonwealth Bank Board in 2000 and 77,000 shareholders voted, and it was a massive event because everyone literally got the annual report and the full notice of meeting in the mail. Now it's just an email, go to a website, no one sees it, so it's not what it once was in terms of having a big impact.
So we've already got an electoral commission, the Australian Electoral Commission, and maybe they should take over corporate elections as well. The problem with that, though, would be that they wouldn't pay. They haven't got the money to pay for the communications, so they'd probably make you pay for it rather than the company or something like that.
Well, I've long argued that you need, in a contested situation, you need to be able to bring in someone, because at the moment, the voting is not even sort of independently audited, and you're not even allowed to have the equivalent of a scrutineer. So you've got to trust Computershare and Link and the big share registries to run a fair election. But it's not, compared to political elections, it is a bit of a joke. And the other problem is the turnout. Literally only 1 or 2 or 3% of retail shareholders bother to vote, whereas in political elections with compulsory voting, it's 93%. So I reckon it should be that you don't get your dividend unless you vote. And that would really get out the vote in Australia, because it'd be the equivalent of a fine for not voting in a political election.
They're never going to do that, Stephen.
Of course, Alan. It was tongue very firmly in cheek. Now, I want to also just briefly mention Electronic Arts. Alan, you've seen that $50 billion take private deal. What did you make of that? The video gaming company with the Aussie executive chairman, Andrew Wilson,
who seems to be on 46 million Australian dollars a year. Goodness gracious! I mean, I never heard of this bloke, and here he is. Making far more than even Shamara Wickramasinghe at Macquarie. So yeah, I mean, I don't know. Look, to be honest, video gaming is a bit of a closed box to me. So I don't know. It seems to be a very lucrative business. What do you make of it?
Well, the Saudis are in there. This is a gaming outfit that has the FIFA franchise and a whole bunch of other sports franchises, but the Saudis seem to think there's the soft power in owning something like Electronic Arts. So I think it's incredible. But I'm just confused by everything that's going on now. Well, I mean, Jared Kushner's, Trump's brother-in-law, son-in-law, Jared Kushner, he's involved in that one, in the take private of Electronic Arts with the Aussie boss. And then you've got the situation overnight where the owner of the New York Stock Exchange has agreed to invest $2 billion in Polymarket at a valuation of $8 billion. And this is just not long after Donald Trump Jr. put some money into Polymarket at a valuation of $1 billion. So the New York Stock Exchange...
You better explain what Polymarket is.
Well, it's just a way that people can offer bets on predictions. So it's how long do you think the US government shutdown is going to last? And then you can start your own market. But it's basically the two big growth things out there are retail prediction and tokenization. And so this deal is leaning in on those two new fintech phenomenons. But the fact that the New York Stock Exchange's owner thinks it's, smart way to go to follow Donald Trump Jr. into a $2 billion investment in Polymarket, which a lot of people think is sort of wild, crypto-styled, cowboy stuff. It's a crazy old world out there, Alan, with AI bubbles and crypto and Saudi take privates and share prices at record highs. And I don't know. I mean, are we getting old and grey? I mean, can you make sense of all this stuff?
No, not really. We're in sort of bubble times, I think.
I mean, overnight, there's a company called Trilogy Minerals. I mean, Trump's just bought 10% of it because it's got, rare earths and copper prospects, and its share price has just absolutely soared because, the US government's just bought 10% of it. And this is playing out here where Lynas, which is our biggest rare earths outfit, its share prices sort of, almost doubled this year, and it's now worth well over $20 billion. So some of the movements we're seeing, whether it's rare earths, gold, crypto, and some of the involvement of US government and the White House taking 10% of Intel, it is just, and then there's just the whole bubble valuation with AI. I mean, what's your latest take on that?
Oh, well, AI, they're making tons of money, but they're making it through selling infrastructure, which is both the semiconductors, which is NVIDIA, and the data centers, which they're building. And those who are building and creating data centers are making money selling the time on the data centers for training of AI. But what's not being done at the moment is companies actually making money from AI itself. So, the question is whether the money, whether these companies that do AI are going to actually make any money in the end. And I don't know. It's hard to say. I can't see how they're going to make as much money as they need to make to justify the investment that's going into it.
But I mean, OpenAI itself, it's now done US $1 trillion in deals. It's been recently announced, whether it's Oracle, whether it's selling shares or them buying chips, or this is this great big merry-go-round of big tech deals. And unlike the dot-com boom back in the day when people were raising money selling shares, in this situation, you've got the biggest, most profitable, strongest balance sheets in the world, all doing these tens of billions of dollars of deals in a big roundabout circle with each other, with OpenAI at the center of it, now having literally announced more than US $1 trillion in deals. And everyone's believing it. Everyone's saying that what you said before, how you're going to make money, well, the share market valuation is that they're all going to make money and this is a great investment and it's going to be first mover advantage and the early bird catches the worm and these big boys are going to capture that worm and heaps of people are going to lose their jobs because, there won't be any call centers and everyone's going to have a personal assistant and, robo-taxis and self-driving and all that stuff. So the market is so excited about this in industrial transformation, which is all around the AI, but it's still a bubble, but it's still also going to be a massive industrial revolution at the same time. And everyone's trying to make sense of it. And it's just mind-boggling.
So speaking of all that, what do you make of Brisbane Broncos soaring after they won the premiership on Sunday, and then going almost all the way back down again? So
we had a Monday bubble, didn't we? Where
one day Monday bubble, yeah. Stock went from $1.30 to $2 or something.
Yeah, well, it traded briefly above $2, and it's settled back at $1.40 yesterday. So I've been on the share register of Brisbane Broncos since 2014 when I bought my $500 worth at 26 cents, sold all but 10 of them because I want to go to their AGM. But of course, Rupert, who controls it, News Corp, they run physical AGMs, so it's impossible to participate in their AGM. So maybe I'll run for their board next April, May when they have their AGM. But they're the only listed sporting club. They're worth $164 million today as a market cap with the shares at $1.40. And slightly different from the other listed company controlled by News Corp, REA Group, which will be having their AGM tomorrow, where Rupert and News Corp own 61% of it, and they're worth $30 billion at the moment. But at $164 million, do you reckon that's fair value for the Brisbane Broncos after they've won their 7th premiership and ended a 19-year drought?
I wouldn't have a clue. I mean, Do they pay a dividend? Why would you buy them?
Oh,
yeah, they do pay a dividend, don't they?
Yeah. There's some pokies in there. I mean, it's not directly owned by them. It's the Associated Leagues Club. But, yeah, so look, it's a real business. I mean, Australia hasn't really got onto that sort of private ownership of sporting clubs. In the US, you're not a real billionaire unless you own, a basketball club or a gridiron club. I mean, they are absolutely enormous. But here we still have this sort of collectivist, fan-owned, not-for-profit model, particularly in the AFL. But the Brisbane Broncos, I think News Corp should sell out now. I mean, it's inappropriate to have a media company which owns the biggest newspaper in Brisbane and has been involved in the rights and Foxtel, and it's just a conflict of interest to actually own one of the teams that you're covering. So I think now would be a good time to sell out.
That's never worried the Murdochs. I mean, they own 69%, right? So the Brisbane Broncos are basically a subsidiary of News Corporation.
They are, yeah, that's right. So, and Melbourne Storm was also created by News Corp and Super League, and they sold out to Matt Tripp, the gambling guy, and a consortium a few years ago. And when they sold Melbourne Storm, they actually agreed to pay the new owners, I think it was more than $15 million over the next 4 years just to prop it up. So Melbourne Storm cost News Corp heaps. It was a loss-making venture, and they had to pay people to take it off them. But Brisbane Broncos, for some reason, they've held on long-term, and it's going well. But I reckon they should sell their $100 million stake now to a bunch of excited Broncos fans, because there wouldn't be a better time to sell than in the post-premiership glow.
Yes, you're right. In fact, they should have sold on Monday.
They should, before it tanked. Yes.
Exactly. So, okay, well, let's do some questions. And before we do that, let's have a quick word from our sponsor.
Want your investments to deliver strong returns without compromising your principles? Join intelligent investors Nathan Bell and John Addis for a free webinar on Thursday, October 16 at 1 p.m. You'll hear why the team behind the Intelligent Investor Ethical Share Fund believes a value lens could supercharge ethical returns, and how they screen for companies to avoid greenwashing. You'll also get a look inside the portfolio, including some of the stocks they own and the catalysts they're watching. Plus, there's a live Q&A so you can ask your questions. Register now at offer.intelligentinvestor.com.au/INES.
Okay, first question's from Glenn. He says, with regard to China blocking BHP iron ore, is this a shot across the bow of Australian policy and rhetoric? We've seen that China has recently decimated the US soy crop and corn growers by diversifying to Brazil and Argentina. Trump has announced a bailout for farmers. I note that a huge iron ore project, Simandou in Guinea, has come online, and also that Brazil has had a 10% increase in its iron ore exports past 12 months. Is our media and government's constant badgering of China as a threat enemy going to bite us where it hurts the most? Should we tone it down? He says, well, no, I don't think it's got anything to do with what the government's saying. I think that it's simply that China's trying to get a better deal out of BHP. And note that since that story appeared in Bloomberg a week ago, that China had blocked imports from BHP, the company said nothing. I can't believe it.
Yeah, it's it's delicate in dealing with China. So yes, it's very Kremlin-like or Delphic. You can't get anything out of them. It's all happening in the background. But look, we're too important to China, because China is the only country in the world that produces more than 1 billion tons of steel, and no other country produces even 100 million tons of steel. So China is 10 times bigger than any other country. Australia is the majority supplier of iron ore in the world, and so it's just the biggest trade ever. Australian iron ore into China. They can't make that 1 billion tons of steel without it. So we are in a very strong position, and that's why I think that the Chinese can't really, turn it off. There's no alternative supplier at scale, like with the soybeans market. And so that's Australia's greatest benefit, the dowry of our iron ore, shipping it to China so they can make the steel for the world.
Simandou in Guinea in Africa is, though, a new competitor. That's true, and it's a big mine, and it's part owned by Rio Tinto, but still it's a big mine, a big potential competitor to Australia.
Yeah. Yeah, I agree. I mean, and look, BHP's also got the pivot to copper because they produce, I think people say 40% of BHP's value at the moment is copper. And the copper price is soaring because there's been closures and a big mine collapse and mudslide up there in West Papua at the Grasberg mine. So, BHP is diversified, and copper's never been a more important part of their portfolio. So even if they do cop some grief on iron ore, they've got the copper play. They've just announced they're investing another $800 million in Olympic Dam, expanding their copper plant up there. So, but look, it's obviously got to be handled carefully. Albo's government's been more diplomatic than the previous operation, and it's a tricky area. Now, Simon says, love the show. When I attended a big private school a little over 2 decades ago, amongst my friends were parents who were main breadwinners, were teachers and police officers. But based on my own situation, $900,000 mortgage and $250,000 household income, I'd surmise that to send 2 kids to private schools, you need to be grossing at least $350K a year, which unless you're a school principal, the chief commissioner, you're not doing. So my question is, how are people finding $40,000 a year after tax to send their kids to private schools? Surely they have to be tapping into the bank of mum and dad, or owning big businesses, or tapping their equity in something. So what's the lesson, Alan, for, $40K is the top end of the market. If you're paying that much, you're paying for the top 10% of schools. But look, it's tough. It's very tough, isn't it?
Well, I reckon that Stephen's friends at school, their grandparents were paying part of the school fees for sure. I mean, that's the way that's the only way the teachers and police officers can send their kids to private schools, if their parents are helping out. And I'd say that's still, in fact, it's probably going on more now than it ever has been. Parents are helping kids with their house deposit and with their school fees. That's for sure.
I think that's absolutely right. I mean, there's never been more inequality where the youngsters haven't got it. It's extremely expensive, and the oldies have got it. I mean, I play squash with a bloke who's quite a well-known commercial real estate, and he was telling me last week he's amazed at how many people, someone's selling their Toorak Road shop, and he goes, Why are you selling, mate? You've had it for 30 years. He goes, oh, mate, my 4 kids, they've got the HEX debts, and I'm helping them with their mortgages, and I'm helping with the school fees. I've got to sell my retail shop investment property to help the kids out because everything's so expensive. So this is happening a lot where people are realising assets to help their kids, because if you're starting with not much, it's an impossible game. It's all about you got to have the equity and the assets to cope with modern living, particularly with housing prices.
Yeah. Bron says, great show. Could you please explain, for GST collections, how do they determine the contributing state? I live in WA but often buy things over the internet from eastern states based companies. When, for example, I buy a Qantas flight, does that count as a WA GST collection, or does it count as New South Wales? Does it matter whether the service is WA only, or does it vary if it's an interstate flight? Are GST contributions paid for by Western Australians actually being allocated as contributions over East? Yeah, well, so look, Bron, the where the GST comes from has nothing to do with where the money is allocated to. It's the money is allocated according to horizontal fiscal equalisation, and it's administered by the Commonwealth Grants Commission. So they just dish it out according to supposed need. It has nothing to do with where the money comes from.
Yes, that's right. So it is the Grants Commission. It's a perennial issue with state governments bickering over the arcane methodologies of the Grants Commission, because it not only is divvying up GST, but it's divvying up what's called financial assistance grants. And because the federal government has most of the tax revenue through corporate tax and income tax, and we've got the most lopsided federation in the world, where the states do most of the work, but the feds get most of the money. Australia has this massive play of transferring money from Canberra to the states, and the GST allocation is just weaved in with all the other Grants Commission calculations. And then you've got side deals where WA gets a guaranteed deal, which has apparently cost the federal budget tens of billions. So it's always been a hot political issue. And then, of course, you get one-off government grants for infrastructure, like, hey, we're going to put $3 billion into the Northeast Link or something, and they're sort of separate from the Grants Commission, just straight out federal funding. But it's a very interesting area, and it's very important because you're talking literally hundreds of billions of dollars overall is collected by Canberra and then divvied up. The GST is part of it, and the Grants Commission, with their arcane methodologies, are central to deciding who gets what.
Yep. The GST pool in 24-25 was $90 billion. So.
And it hasn't been the growth tax. That income tax, I mean, corporations tax was $142 billion last year, a record, and income tax is, what, $330. So GST has not been the growth tax compared to income and corporations tax. Now, Joe says, I have an armchair critic idea for productivity and government revenue. May I get your feedback? Introduce a marginal levy on consumer debt, such as 10 to 50 basis points, then hand control of the levy to the Reserve Bank and use it to manage consumer-led inflation while making investment comparatively cheaper. The RBA can then lower it when consumer demand is needed. If it was introduced to coincide with a rate cut, it would likely cause less pain for consumers, would also presumably need grandfathering. Now, we get lots of ideas, Alan. What do you think of that one? Effectively, giving the RBA more power and tweaking effectively a GST, isn't it? A consumer debt levy.
Yeah, well, it wouldn't be enough. I mean, the problem is in the question, which is that it would likely cause less pain. But the point about monetary policy, as governed by the Reserve Bank, is to cause pain, and so the interest rate changes of 0.25% or sometimes 0.5% are generally regarded as the gold standard. And yes, you could do something else. That's for sure. All sorts of different ideas. But the thing about interest rates is that it's independent. It's not a tax. It's something the Reserve Bank can do. And the trouble with any kind of levy is that it's basically a political decision, and politicians don't want to have anything to do with monetary policy. They don't want to have anything to do with causing pain.
Unless you're Donald Trump, of course, who wants to stack the central bank and lower interest rates to 1%. But most politicians globally accept that interest rates should be independently set.
Yes.
So I think the only two taxes really, the way you've seen an example of adjustments that can help with cost of living is probably the fuel levy. Remember when ScoMo temporarily got rid of the fuel levy, and also all the bailouts on electricity pricing, all the government subsidies. That's sort of been a cost of living measure where governments can get involved in the price of electricity by simply paying the electricity companies to give the consumers credit to lower their power bills as an economic need in the cost of living crisis. But
note it's only done when it's actually reducing the price rather than increasing it. What the politicians don't want to do is actually be responsible for causing pain rather than relieving it. And
yes,
I mean, Trump wants to control the Reserve Bank because he thinks interest rates need to come down, but he certainly wouldn't be doing it if interest rates had to go up.
Yeah, no, that's exactly right. So now Gary from the Sunshine Coast has sent in a long screed. I won't read it all, but he's basically said that he's been feeding in annual reports to Copilot. And in the case of the listed company Breville, they came back with a fantastic suggested question at the AGM, which said Breville has now delivered 10 consecutive years of EBIT and revenue growth. As the business evolves into a platform-led ecosystem, how is the board ensuring that capital allocation decisions, particularly around digital platforms, geographic expansion and manufacturing diversification, are disciplined, ROI-driven and aligned with long-term shareholder value creation?
So you're going to start using AI now, are you, Stephen?
Well, I think particularly with written questions, Alan. I mean, I love the efficiency of written questions where you can do 8 meetings in a day. You just cut and paste your question into their system and the company reads it out. So for that format, I think that AI is a genius and I really should be getting into it. Whereas oral questions at the meeting, it's just a bit more tricky. So I do think for anything written, like even some of my platforms. Dear AI, what platform should I run as an independent director at the Myer board? I mean, that would probably be quite good. So yeah, I need to break my duck and bring AI to shareholder activism. It's a great suggestion from Gary.
Benjamin says, my parents-in-law are aged mid to late 70s and have burned through all their super and are struggling to get by on the full pension. They own their own home, which is worth around about $1 million. I've looked into reverse mortgages for them, but the ongoing fees and interest rates seem criminal. We are in a fortunate position to help their cash flow needs. One idea that we had was to purchase 5% of their house each year for the next 5 years. My understanding is that this will keep them under the assets test and the incomes test and not affect their full pension. I know that there's a stamp duty impact for each transaction. My question is that does this seem to be a sensible transaction for us and them? Would you be transparent with other likely beneficiaries to the inevitable estate? Well, firstly, Benjamin, yes, you'd have to be transparent about it. I mean, are there other beneficiaries? Because if there are, then you buying 5% of the house each year is going to obviously disenfranchise them to some extent. I mean, why not have a family meeting and get everyone to chip in if they can?
Maybe Benjamin being the reverse mortgage provider would make more sense. Because I think that stamp duty is ever present and you don't want to needlessly pay stamp duties, and microtransactions on properties, it's quite tricky. So I do agree with Benjamin that reverse mortgages are overpriced. There's not enough providers. It just should be a standard product by all banks, but banks are fearful of, kicking grandma out of her family home because she hasn't made her mortgage payment. So they just say, we're not going there. And it leaves a lot of people with low income and assets struggling to get a decent reverse mortgage because there's not enough providers. So, but I think that if they're on the full pension and they've got a $1 million property, I just think the parents just help them with the cost of living and lend them some money, which comes back to you when years down the track.
Maybe they also maybe they need to move into an apartment and free up some cash just by selling the house. I mean, they probably don't want to. They probably don't want to. They like living where they are, but sometimes you just can't do it. I mean, maybe they just got to move.
And this is the opposite of the most common thing. This is kids helping their parents, whereas the whole narrative at the moment is the other way around, isn't it? So
it is, yeah.
Now, Luke says, I currently invest my super in index funds to track the share market and keep fees low, but that leaves me with no exposure to Bitcoin. I've looked at my existing super funds investment options and there doesn't appear to be a way to invest in Bitcoin. Ideally, I would like to maintain my index fund investment but gain some exposure to Bitcoin. Can you suggest any products?
Yeah, well, Luke, there are several Bitcoin ETFs. VanEck's got one. BetaShares has got one. I mean, most of the big players have got a Bitcoin ETF. Just Google Bitcoin ETF and you'll find them, and then go on the stock exchange and buy them if you want to.
I think it's fair to say that our super funds overall and our big banks, so big banks and big super, and I don't blame them for this, very conservative. They're not sort of the New York Stock Exchange putting $2 billion into polymarket sort of stuff, are they? So, so you probably do have to find your own ETF rather than expect Aussie Super or Hester or someone to be trumpeting great Bitcoin options. Although, it's obviously like gold, it's digital gold, and it's been absolutely booming. So anyone who has been invested in Bitcoin, it's never been better.
Yeah. Well, Luke doesn't seem to realise that there are Bitcoin ETFs, but anyway, there are. Your turn.
Now, Andrew, is there somewhere, Alan, for us to go and look at all your graphs from the news? Maybe it's time to get social media to share some of your best. And will there be any more Chris and Alan collaborations?
Oh.
So the back catalogue of graphs, Alan, where are they?
Well, I put them in weekend briefing usually each week. Not every single one, but most of them go into weekend briefing, and I have a charts of the week section in the weekend briefing, and they are usually in there.
Only about 20 a week, so that's right. If you really want Alan's charts, there will literally be on average 15 to 20 at the bottom of his Saturday morning weekend briefing, which is the best read.
Which is for subscribers. And apart from that, I don't know where else you get them, to be honest. There's no kind of free website where they are. No.
Yeah,
but I'm afraid you'll have to take screenshots.
Yes, indeed. Now, Andrew also asked, will the first home buyers scheme mean buyers will be limited by how much the banks will lend them? So salary will become the limiting factor. So what do you think about, we've got to talk residential property, Alan. What do you think about the new first home buyers scheme, which is seemingly causing a bit of a frenzy and driving prices higher?
Yeah, well, Treasury modelled the impact of it and said that it would be 0.5% on house prices over 6 years. So I think that's too low. It'll probably be more than that. But look, I don't think it's going to be the main impact. I don't think it'll be a huge. The economists are all going crazy about it, and fair enough. That's what you do. But the thing about the scheme is that it's designed to try to broaden the access to a new home to people who don't have access to bank of mum and dad. Because at the moment, the only people who can afford to buy a house or get the deposit for a house at 20% of the buying price are those whose parents are rich enough to give them money. So, and that's creating this huge inequality in Australia for those who do have parents with that kind of money and those who don't. So now suddenly those who don't have those kind of parents can buy a house with a 5% deposit. I think that's fine. That's a good thing, in my opinion. But yes, it probably will drive house prices a bit higher. But the main impact on house prices clearly is interest rates. That's the main thing. And house prices have gone up 5.5% this year already, thanks to 3 interest rate cuts. And within that context, 0.5% or 1% or even 1.5% from the 5% scheme, first time buyer scheme, is not that big a deal, really.
And as for Andrew's question, yes, income serviceability, as in your salary and your overall balance sheet, will drive big bank lending ratios as ever. So I don't think the new government scheme is going to change the way that the banks will lend. They'll stick with those evergreen formulas of how much have you got to pay the interest and pay us back and what's your overall asset base. Now, boss, you can pick the last question. What do you want to go with?
Okay. Well, might as well continue on the same thing. Josh says, how much does our obsession with home values and asset growth contribute to its growth? Use the chat around barbecue example. There is always something to talk about because of the availability of data and its presentation to the public. Now it seems this is done in a way that is accessible and easy to understand for the layperson. Just about every graph line shows this. Housing to asset equals growth. Housing as an asset equals growth, and growth is good. At what point does this break? Or is a black swan type of occasion the only thing that will? Yeah, what do you think?
I don't think it's ever going to be a black swan event that's going to break it. I do think it's going to come off a little bit. It is overcooked. In terms of why we always obsess about it, talking around the barbecue, I've actually got an interesting thought on that one, Alan, too. So REA Group, the Murdoch-controlled realestate.com, how different would it be, this whole constant focusing and talking on property, if every single property in the country wasn't online and you could just look it up and invade someone's privacy and find out how much they paid for it and the size of the house? And I mean, I think the open data and the way that the Murdochs have been able to monetize that through realestate.com is quite unusual. And if you compare it to share registers, it's illegal to look at a share register to report someone's wealth. So you can't go and look at the Macquarie Group share register and say, oh, look at Johnny Smith. He owns 100,000 shares. He must be a rich guy. That's against the law. But every single property transaction, residential, is public. It's on the REA website. People are constantly looking at the REA website. They're monetizing it, and everyone goes to their barbecues and talks about the latest house prices because it's so incredibly transparent with open data. I mean, do you think it's an invasion of privacy, Alan? Is all this data on every single real estate deal in the country, is that causing us to be obsessed with property?
Well, we're certainly obsessed with property. I mean, as to REA's part in it, I guess it is to some extent. I mean, are people talking at barbecues about houses that aren't being sold? Are they saying, oh, look, house up the road is, last sold at this? Are people doing that? I suppose they might be. They could. You certainly could, couldn't you? So, yeah, I don't know. But I do think that the data about house prices that, comes out every month, and we're all talking about, today, this month house prices increase is this and so on. I think that is a bit too much. But I think the whole problem with part of the problem with housing is that it is treated like a market, and people talk about it as if it's like the share market. But obviously, it's different in that the houses are things you need to live in. It's a human right as opposed to a share, which is you can't live in it. It's not a human right. It's just a thing you trade, like gold or whatever. I mean, I think the problem is housing is seen as an investment market.
It's perfectly appropriate to finish with Alan talking about housing. Well done, boss.
Thanks, Stephen. And thanks, everyone, for listening to today's episode of Money Café. I'll be back next week with James Thompson. As always, send in your question to themoneycafe@eurekareport.com.au. And we'll be back then. I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor and a person on the ABC.
And I'm Stephen Mayne, and we'll see you in a fortnight.